Hello, beautiful people, and welcome to this week's edition of the ITU Forex class, where we're going to be talking about market structure for beginners. So, if you guys can remember, last week we talked about trend trading for beginners, and we actually delved right into the advanced topics after we laid the foundations for exactly what trend trading was and how to use it how to take advantage of it, how to exploit it to improve your trading performance. Now, this week we're going to build upon what we learned in last week's class and also take it a step further so that you can be able to speak the language of the markets, which is price action. Okay, so without wasting any more of your precious time, let's dive right into it now. So, what exactly is price action? The reason why I'm asking you price action and not market structure is because price action has you need to understand price action before you can understand market structure. So before we actually do the scribble and all of that, everything you're seeing on the charts right now, all of the movements you're seeing on the charts, the candles and all of that, and it doesn't just limit it to price to when you're studying the markets with a candlestick chart. You could be studying the market with something like a line graph or something like a bar chart, and still we are looking at price action because to put it in a nutshell, price action is just exactly how price behaves in the market. So whether you're using a candlestick chart or you're using a line graph or you're using a bar chart, all of this information you're seeing on the charts is representing what price is actually doing at this particular moment in time. Okay, so it's just a representation. The type of charts you're using to look at price action or to gain insight into what the market is doing is just a window for you to actually study what the market is telling you by the price action that it's showing you. So it doesn't matter if you're using a candlestick chart, a bar graph, or a line graph to see what the information in the market is telling you. All of this is price action. Okay, so like I told you, you need to understand price action, a bit of it, before you'd be able to understand market structure, because price action is what the information that the market is telling you, regardless of how it is being represented. While market structure is a basic building block, the basic building blocks of how price is actually structured in the market, how price moves in the market. Okay, so with that out of the way now, let's move on to the charts. Let me quickly show you this. So from last week's class, you can remember that I told you that trend trading is basically when price is moving in a particular direction over a sustained period of time. Okay? So for example, if we say that the market is in an uptrend, okay? If we say the market is in an uptrend, this doesn't mean that price moves in a straight line all through that uptrend. No, it doesn't. What it does mean, on the other hand, is that even though price could pause and retrace for a bit, when you strip it to the bare basics, at the end of the day, over a sustained period of time, the move that price is making is towards a particular direction. So if the market is in an uptrend, over time you're going to have price doing something like this, okay? Something like this. It's going to be moving up. But that doesn't mean it's just going to start moving from all the way down, going all the way up in a straight line. It's usually going to move a little bit, then it's going to pull back. Then it will move higher than it did the previous time. Then it will pull back. And it will do the same thing. It will keep doing the same thing over and over and over again, as long as the trend is intact, as long as the trend is healthy. But if the trend, for whatever reason, starts to weaken, the steam in the trend, okay, the momentum, that the move that is causing the trend to keep breaking above previous highs and previous lows and whatever, to keep forming these brand new highs and brand new lows. If the momentum behind this move starts to weaken, then you're going to start seeing things like divergence. You're going to see price struggling to break previous areas of resistance. And once you start seeing things like this, then this is a warning sign telling you that obviously trends don't last forever. So the move that you're seeing, the momentum behind it, the steam behind it is starting to weaken. So you can expect that any moment from now, price could easily break below the higher highs that it was forming, the higher lows, that it was forming, to either consolidate or start a brand new trend to the opposite direction. Okay, so I told you that in a trending market, basically what you have is price is going to, in an uptrending market that is, price is more likely to keep forming higher highs and higher lows, higher highs and higher lows, higher highs and higher lows, especially if that trend is healthy. But once that trend starts to weaken, then price is going to be finding it difficult to keep breaking those high levels. And that's when you're going to start seeing things like, a formation of chart patterns like the double top, like the triple tops and all of that, and, head and shoulders. This is where you're going to see all of that, because price is struggling to continue breaking those highs like it did in the previous time, because the momentum, the steam behind the move it has is beginning to weaken. And so when there's an uptrend in the market, and if that uptrend is actually healthy, price is going to continue to form higher highs. Okay, this is a higher high because it's higher than the previous high, and higher lows because this is a low and this is a low that is higher than the previous low. Again, this is a higher low because it's higher than this previous low. This is a higher high because it's higher than this previous high, and this high is higher than this previous high. So as long as the trend is intact, price is going to continue forming higher highs and higher lows, higher highs and higher lows, higher highs and higher lows. But then all of a sudden, look at what happens here when the trend begins to weaken. Okay, so let me pick this and quickly fix this a little bit. Okay, so as you can see here, what we have is the market is beginning to struggle. Okay, it's beginning to struggle to break above resistance, but it wasn't struggling in the past. When it came to these previous resistance areas in the past, it broke through them like a hot knife through butter. It was like they were not even existent there, because there was a very, very strong momentum behind the move. But now that the momentum is weakening, now that the volume of orders or the magnitude of orders that were pushing prices past the previous resistance, the demand that was making it, pass through these levels is beginning to weaken, is beginning to dwindle. You can see that price is now struggling to break above previous resistance areas like it keeps doing here. And this is when you see chart patterns on your chart like the double top, the triple top, the head and shoulders, and all of this. These chart patterns are all chart patterns that are telling you that, look, the momentum that price had in the past, where it was breaking above resistance areas and forming brand new highs, is beginning to weaken. And so price could either consolidate or reverse its direction completely, reverse the direction of the trend. It's not rocket science, why this technical analysis approaches work. It's just because that's how price moves in the market. Now, when we're talking about trend trading, we're talking about price moving in a particular direction over time. Okay, but when we're talking about market structure, we're actually talking about how price does that movement. I need you to understand this. When we're talking about trend trading, we're saying that, let's assume that this whole price action that you're seeing on the chart. So let me put it this way, like this. Let's say all of this price action, it took it like 4 weeks. Let's say this is the 4-hour chart. And so all of the price action that you're seeing here, it took it 4 weeks. Now, at the beginning of this move, that's the beginning of this 4-week period, price was all the way down here. And just for simplicity, let's say that when price was all the way down here, let's say we are using the GBP USD currency pair, for example. So let's say that this price level was like 180.00. Let's just keep it at a round number for simplicity. But at the end of this 4-week period, you can see that price is at, let's say, a 200.00 price level. So when we're talking about trend trading, we're saying that over a period of time, price actually increased in value for an uptrending market. Okay? Now, does this mean that price just moved in a straight line? Obviously, you can see from the charts that price didn't do that. It moved up for a bit, okay? And then it will pull back and rest. Then it will move up higher, and then it will pull back. And then it will move up higher, and then it will pull back. Now, this method of movement that price is exhibiting here, the method that is showing the formation of these higher highs and higher lows, is what is referred to as market structure. Okay, because the market structure is exactly how price moves in the market. The structure of an uptrending market is the formation of higher highs and higher lows. Okay, the structure of a downtrending market is the formation of lower lows and lower highs. Excuse my drawing. Lower lows and lower highs. Lower lows and lower highs. So if we start all our labeling all the way up here, this would be our high. And then this would be our low, because this is the origin point, okay, where price started to move from, okay, in this particular example. And then when price moved all the way to this low, it stopped here. It couldn't move any further. But then when you draw this line across, let me see if I could just make this a little tidier. Okay. Okay, let's do this. Okay, so our high started here, and then higher highs, sorry, lower lows and lower highs, because this is a downtrending market. Okay, so this is the origin point where the move started, where the move began. And then this is the low. Now, when price came to this level, for some reason, the sellers just didn't have it in them to continue pushing prices down. They had to take a rest. And this is when we had this pullback here. And then eventually, because it's a healthy downtrend, price had enough momentum, when it gathered enough momentum to come back and break below this level that it failed to break the last time it was around here. Now, this is going to be our lower high. Why is it a lower high? It's because this is a high and this is another high. But when you compare this high to this very high, you'd see that it's lower than this previous high. And that's why it's called a lower high. This, on the contrary, this is a low. And this is our brand new low. Now, when you compare this brand new low with the previous low, you'd see that this low is actually lower than the previous low. And that's why it's called a lower low. So we've got, remember, lower lows and lower highs. Okay, lower lows. This is a, let me move my drawing board here. Oh, sorry, let me move it here. So this is a lower low and this is a lower high. Okay, now the same thing applies to a downtrending market. Okay, I'm going to clear this and I'll do the drawing in a way that you'd see exactly what we're talking about. But when the market is trending, if that trend is healthy, for an uptrending market, there's going to be a consistent formation of higher highs and higher lows, higher highs and higher lows, higher highs and higher lows. When that move begins to weaken, then price is either going to start forming, equal lows and equal highs, which will most times lead to the formation of double top chart patterns, triple top chart patterns, or whatever the case might be. Those names are just there to show you what price usually do, okay, when there's an exhaustion in the move that preceded it. And for a downtrending market, usually the characteristic or the anatomy of a downtrending market is that price is going to be forming lower lows and lower highs, just like you're seeing here. Lower lows and lower highs, as long as that trend is healthy. But if that trend is not healthy for whatever reason, what you're going to find is that, look, price is going to be forming lower lows and lower highs. And let me clear this for a bit. Okay, price is going to form lower lows, lower highs, lower lows, lower highs, lower lows, and lower highs. But the same thing applies here. What do I mean by the same thing applies? This same thing that we said about the uptrending market, where if the momentum begins to weaken, you start seeing price finding it difficult to break below the levels that it had in the past. The same thing applies also in a downtrending market, because that's when you're going to see equal lows and equal highs, leading to the formation of double bottoms and maybe inverted head and shoulders and all of that. This is just psychology in play here. This is telling you that if the move is very strong and if there's money backing that move, big money, smart money backing that move, the move would have no reason other than to continue breaking below support levels and forming brand new lows. Okay, breaking below support levels and forming brand new lows. But if for whatever reason there's not much volume or momentum of magnitude of the short orders that would continue pushing prices down because of supply, then you're going to see price finding it difficult to break these levels. Now, we've talked about, let me quickly do this. Number one, we've talked about the trending market. Okay, the trending market. And we've said that the market structure, okay, the market structure of a trending market is either the formation of higher highs and higher lows, as in the case of an uptrending market, or the formation of lower lows and lower highs, as in the formation of the market structure, anatomy of an uptrending market. So for an uptrend, we'll say an uptrend, okay? This right here, okay? For an uptrend, we've got the formation of higher highs and higher lows. But is this the only type of move we have in the market? Remember, we're not, last week, like I keep telling you guys, we talked about a trending market, okay? Last week we talked about a trending market, but a trending market is not the only type of condition that the market exists in, or the behavior that the market exhibits. For a trending market, basically we have two outcomes. We have an uptrending market or a downtrending market, okay? Or a downtrending market. But when we're talking about market structure, which is what we're talking about today, we know that apart from trending markets, we have another thing which is known as consolidating markets. Okay? Consolidating markets. This is a consolidating market condition. You would have heard traders talking about this. And we also have the third market condition, which is a ranging market condition. Okay? Now, for a trending market condition, we told you that if it's an uptrend, we have the formation of higher highs and higher lows. Consistently, higher highs and higher lows. And then if this move is beginning to lose momentum, then we will have the formation of equal highs or equal lows, leading to the chart patterns, formation of chart patterns like double top, triple tops, and all of that. But what of a downtrending market? Again, for a downtrending market, we have the formation of lower lows and lower highs. Lower lows and lower highs. Lower lows and lower highs. But then if the move is beginning to lose steam, then we have the formation of equal highs and equal lows. Okay? Now, what of consolidating markets? Before I tell you what it is, I would like to give you guys an opportunity to type your answer right now. Type your answer in the comments, in the chat box and all of that, okay? Type your answer. What do you think the market structure of a consolidating and a ranging market looks like? If the market structure for a trending market, in particular an uptrending market, is characterized by the formation of higher highs and higher lows, and the formation of lower lows and lower highs in the formation of for the downtrending market, what do you think the market structure of a consolidating and a ranging market would look like? Okay, let me quickly answer the question. The consolidating market, what it is characterized is by the depletion of momentum in the market. So usually what a consolidating market would look like is price would be moving from, let's say, from a low here to a high point here. But then when it pulls back, instead of acting like an uptrending market where price is going to break above its previous resistance and continue moving up, or like a downtrending market where price is going to break below its low to continue moving down, price is actually going to find it difficult to do either of this because there's a depletion in momentum. There's the money that is moving the moves which are occurring in the market is not that much. And so this causes kind of a consolidation in the market. So instead of price now breaking above highs or lows to form brand new highs or lows, price is going to find it difficult to even test the highs or the lows that it printed previously. So continuously, price is going to keep finding it difficult to test the previous highs and previous lows, leading to a formation of what will look on your charts like a triangle. So you must have heard in chart patterns that we've got a triangle or symmetrical triangle, ascending triangle, descending triangle, all these type of triangles. They are caused by a depletion in momentum in the market, which is usually when we have consolidation in the markets. Okay, this is where you see because in a normal uptrending market you see price forming, like I keep telling you, higher highs and higher lows going up. Downtrending market, lower lows and lower highs going down. But for a consolidating market, price cannot even test the previous highs or lows that it printed. It's going to find it very difficult to even retest those areas, and so it's going to lead to price action which looks like this, characterized by the formation of triangles. We've got symmetrical triangles, ascending triangles, descending triangles. While for a ranging market condition, we would have the formation of equal highs and equal lows, because instead of price breaking above resistance or support levels to continue forming higher highs and higher lows for an uptrending market, or lower lows and lower highs, or highs and lows that are not even up to the previous highs and lows, which is the type of market structure that forms during a consolidation market. A ranging market is characterized by price just bouncing off of levels of support and resistance because it can't break above or below them. Okay, so these three type of conditions are what we have, the type of moves that price exhibits in the market, which is consequently broken down to its bare form, which is known as market structure. Because when we talk about the market structure of an uptrending market, we have higher highs and higher lows consistently forming until that move weakens and whatever. And a downtrending market is characterized by the formation of lower lows and lower highs. For consolidating markets, we have a high and a low, and then we've got lows and highs that are not even up to the previous lows and the highs. And for a ranging market, we've got equal highs and equal lows, because price is finding it difficult to break above either the support or resistance area. So it just keeps bouncing off of those levels. Now that we understand this, it's going to make it a lot easier for you guys to really see how to put it in action when we look at the price charts, for examples, okay? So let me quickly do this, okay? Let me quickly do this. Yep. So what do we have on my chart here? You can see that here, the example that we have on this particular portion of the chart is a downtrending market. Why do I say it's a downtrending market? Well, first of all, when we look at the chart, you see that in this time period, if you're using TradingView, okay, you have the ruler tool up here. So when we measure the price action from all the way back here to all the way here, you can see that because this is the 4-hour time frame, okay, you can see that this particular price action that we're looking at on the chart, it actually took something like let me use the ruler tool again, from all the way up here to all the way down here. You can see that this particular price action actually took like 42 days to form. Let's just say 43 days, okay? 43 days, approximately 1 month and something. Now, why do I say this is a downtrending market condition? Why? The reason is simple. It's because when you look at the charts here, price started moving from all the way up here. And if you look at the price axis, you see that it was at the 198 something level for the GBP JPY. That's at the beginning of this 43-day period, like I told you when we looked at with the ruler tool. But currently, you can see that price is around the 188 period. So it's like it fell down more than 100 pips or whatever the case might be. Sorry, 100 pips is even so little. I think 1,000 pips in this example. Okay, so in this case, you can see that price moved from all the way up here to all the way down here. But this move, because the move over a period of time was to the downside, okay? So, but this move, this downtrending move, did it just move down in a straight line? No. And this is because I told you that when price moves in the market, it obeys the laws of market structure. Price doesn't just move up in a straight line, no matter how strong a trend is, or move down in a straight line. Usually, what you would have on the price charts is that even if the market is in an up or a downtrend, it's going to move up a bit and then it will pull back. So you can see that price started moving down from here, and then it formed from this high, it came all the way down here to form this low. And then it moved up, okay, to form this lower high. Why is it a lower high? Because this high is actually lower than this origin point, this high. And then all of a sudden, price moved all the way down, breaking below this support area to form what? To form a lower low. So this again is showing us that there's a downtrending market move. And you can see that here, price broke below the support area to form a brand new low. So this price moving from here to here, we're in a downtrend. And like I told you, as long as the trend is healthy, price has no reason whatsoever to break above the lower highs, except if it's consolidating or if it wants to reverse altogether. And that's what we had here, because after price broke below this low, you can see that it barely broke below it. The momentum behind the move that caused price to break below this low, this support area, was just slightly there. It was like, from forming big red candles, okay, and breaking below these levels with strength and all of this magnitude, it barely forms candles that have, big bodies here, the red candles here. So there's kind of weakness here. There's divergence, there's exhaustion here. And you can see that that was translated on the chart to when price broke above this lower high. Even though it was temporary, but still, price had to consolidate. And so when we had the formation of this high, okay, you would assume that if this is truly an uptrending market, price should continue forming higher highs and higher lows. But then all of a sudden, price came here, tried to break above the resistance area. It failed to do so. And then it continued its downtrending market move, forming lower lows and lower highs, lower lows and lower highs. So what market structure is, in essence, is how price moves in the market. Like I told you, when the market is in an uptrend, it's not just going to move up, shoot up in a straight line. When the market is in a downtrend, again, it's not just going to shoot down in a straight line. Or when it's consolidating, it's usually going to follow a pattern which has been exhibited in the markets over and over and over again. Over and over and over again. Okay? So let's look at another example quickly before we wrap up the class. Now we've talked about a downtrending market. I know you could spot examples of an uptrending market. You can see this is exactly what an uptrending market looks like. When you have the market structure of an uptrending market, the formation of higher highs and higher lows, higher highs and higher lows. This is exactly what we have here. Okay? But then what I want to show you is what I don't show all that much, because even though it occurs on the charts, it's not all that much. We tend to focus on, because it's easier for you to exploit trending market conditions, to place trades and capitalize on them by taking profits. It's a little harder, especially for beginners and traders who are struggling to be profitable, to take advantage of consolidating markets, okay? Because, you need price to move to be able to, take trades and get price to hit your profit targets and all of that, especially if you're trading with high risk to reward ratios, like you're risking 1 to make 2 or 3 or whatever. If a market is consolidating, yes, you take a trade, but it's going to be difficult for price to hit your profit target, especially if you are risking less than you are aiming for. You're trading with a positive risk to reward ratio. And that's why most times I tend to advise beginners, especially traders who are struggling, to stick to trend trading strategies or range-bound trading strategies. But I prefer trend trading strategies because it's easier to use them to exploit trending market conditions to become profitable than for you to trade when the market is consolidating, because there's not much volume in the market. That said, this is a clear example of what the market looks like when it's consolidating. So you can see that we moved from the formation of higher highs and higher lows. The market was in an uptrend, obviously. But then when the market formed this high, when it reached this high area, for whatever reason, it was finding it very difficult when it tested it again to break above this high and continue forming higher highs and higher lows. Now, when you see a market struggling to break above the previous high that it set, even though it was forming higher highs and higher lows, what does that tell you about the uptrend which preceded it? That the uptrend is weakening. The uptrend is weakening. So there's no much volume behind the move. Is that a good time for you to get in the market with a long trade? Of course not. Because you need momentum. You need to piggyback off of the smart money, the guys who are moving the markets with their orders, to take advantage of the moves they cause in the market to actually find profitable trades. But when they are finding it difficult, or when they are not willing to break above resistance areas with a magnitude of orders, then that should tell you something. They don't care so much about the market breaking above the resistance areas. And this is what you're going to see when the market is consolidating, because price is struggling to break above resistance, is also struggling to break above support. And then it's going to keep consolidating, moving, shrinking in volume. And then we'll have something that looks like this, the formation of a triangle. Okay? And when I pick this tool here, and I drag this, you see that this is where this diagonal that price is finding it difficult to break above, and this is the lower point. So this is what we see in the market. This is like a symmetrical triangle being formed. Okay? But what does this have to do with anything? Just like trends don't last forever, consolidation in the market also doesn't last forever. There's going to come a point in time where price is going to break either to the up or the downside. And when it does that, you can see that now exactly what we want is what we see happen. We want to trade when the market is trending. And so since consolidations don't last forever, when the momentum is weakening, there's going to come a point in time where price is going to break out of that triangle. And then it did that. And when it did this, you can see that here we had price at this low, and here price broke below to form a brand new low. But then when price tried to retest this area, it couldn't break above this area, leading to the formation of this is a low, this is a high, and this is a low. Then this is a lower high because it's lower than the previous low high, and then this is a lower low because price had broken below this support level to form a lower low. So we've got the market structure of a downtrending market, which you can now take advantage of with your trend trading strategies. Okay, so to recap what we've just learned, market structure is the way price moves. Price action, on the other hand, is the information that price is telling you on the chart. It could be represented with a candlestick chart, with a bar chart, or a line graph. It doesn't matter. But whatever the case, whatever you're using, market structure is what is exactly how price moves. While price action is the building blocks which form market structure to show you how price move. So you need to understand both of them for you to be able to be a good trader who would spot or understand the language of the market, understand exactly the information that the market is trying to tell you to exploit these moves, okay? So this pretty much brings us to the end of this week's edition of the ITU Forex class. But again, before we wrap up, like I keep telling you guys, these part of the classes, this part of the sections of which we're teaching you in the company is for you to learn and improve how to become a consistently profitable trader using manual trading techniques. We've got other trading tools and bots which would help you to analyze the market on your behalf, especially if you're learning. They would help you to analyze the markets, do proper risk management for you, place the trades for you, trade for you basically while you're out there doing the things you want to do with your time. You don't need to stay glued to the chart. So if you're interested in those, reach out to us on our social handles and we'll be more than glad to help you set everything up, okay? So if you're interested in it, reach out to us on the social handles. We've got a lot of bots which would help you trade on your behalf and make profits for you. So once again, thank you very much. And I look forward to seeing you guys in next week's edition of the ITU Forex class. God bless you and enjoy the rest of your week. Cheers.